Great operators don't buy well, they exit well. Most of your returns on an apartment building investment are decided before the deal even hits the market. So the problem is many operators kind of wing the exit. They don't really strategize or think too deeply about who that future buyer might be. They wait too long, they sell into soft demand, or they refinance into risky debt, right? Which can turn solid operations into mediocre outcomes. So, in this episode, we're going to dive into our clear decision framework for exits, the prep work that lifts price, the timelines we run, and the guardrails we put in place to protect limited partners when the market shifts. Now, at Faris Capital Partners, I want to give you a little behind the scenes about sort of our deal review process because it's multiple steps, right? It's not just like, oh, here's a deal, we underwrote it, let's review it. So, a little behind the scenes, our analyst will take the deal that comes in and we look at every deal that comes across our desk that fits our buy box. Even if we're looking at it and go, we're not sure it's for us, right? It's kind of like Wayne Gretzky said, you miss 100% of the shots you don't take. So we look at every single deal, and that analyst's job is to take the seller's current financials. We typically get a rolling 12-month, a T12 set of financials, as well as a rent roll. Now, the rent roll is basically an accounting for every lease. So it shows when the lease was originally written, when the lease expires, what the rental rate is, what the original rental rate is compared to what the current one is. And so it also will show delinquencies, things of that nature, right? So we study that, we roll that into the model. And so we do basically what we would call like a back of the envelope underwriting. So with those financials and that rent roll information entered in, is this a deal we even want to consider spending any more time on? So once that box is checked, it actually goes over to our senior vice president of acquisitions who does a full underwriting. Now, we've done episodes on our underwriting process. It is deep. We do not just, make assumptions, right? We're looking at multiple data sources from CoStar, Site to Do Business. We are pulling our asset manager in, bringing her expertise in. We actually send the deal blind to our property management team for them to sort of underwrite and look at rent projections and organic rent growth projections, look at the competition. We do that blind because if we sent them all our information, they might come back and say, yeah, this looks great. So we almost want like whole other set of eyes on the deal, right? And so we go through that. So once the team is ready to look at this deal, once like Joe, who's our senior VP of acquisition, says, okay, I like this deal. George, our senior vice president of asset management, has signed off on it. That's when we finally have what we call our investor committee meeting where we review the deal. Now, how that looks is initially Joe just goes through the high level numbers, the business plan, the thesis. There's about 15 questions that Mark and I ask on every single deal. So it's actually like a worksheet. So Joe goes through that and says, here's this, this, this. It covers all these bases. So we're like, okay, now we like this deal. What's interesting is the first question Mark and I tend to ask after that before we go any further, and we'll spend a few hours on these calls to be clear. So we spend about 10, 15 minutes reviewing it. The first question we ask is, who's the future buyer, right? And so that could be driven by so many factors, right? What submarket is it in? Is it in a submarket that is, attractive for multifamily investment, but maybe not the type of market that some of the large institutional players would be interested in, right? And so we say, okay, we have to eliminate that pool of buyers here. Will there be another syndication group similar to Faris Capital Partners that might be interested in taking it on? Part of our strategy generally is when we take a building down, we want to prove the thesis. And so, for example, we buy 104 units in Largo. Our business plan, we actually raised the capital to do 100% of the units because we wanted to make sure, if necessary, if say, for example, we get to year 3 or 4 and we realize we need to do some more work here to drive NOI, we have the money in the bank to complete the renovation. But our typical strategy is to say renovate about 60 to 70% of the units out, prove the thesis, and then we can sell it to another operator similar to us who can then come in, complete that value add project. So we like to say we like to leave a little meat on the bone for that next operator, right? And so that's sort of one of our strategies. So in that context, that might be another syndication group like us. But occasionally we see opportunities like our deal in Charleston called Strawberry Station. That was a 36 unit townhome deal, likely not going to be a target for a syndicator. So that's likely going to be more of maybe an ultra high net worth individual that sees the opportunity to buy an existing building that's running wonderfully, operations are tight, and there's consistent cash flow coming in. So they're buying it simply for the cash flow, right? So it's important to know who that buyer might be. And so that's the first question we ask. And once we sort of get comfortable there and we realize, okay, now let's get into the weeds, let's get into the details of the deal and start interrogating every component of the underwriting. So basically there's like 3 to 4 primary exit paths. The reason I say 3 to 4, there's one that is not necessarily applicable to us at Faris Capital Partners due to our investors being in Canada, but we're still going to cover that. Now, number one is just sell, right? Outright disposition. So, we buy the deal, we execute our business plan, we look for opportunities to improve operations, reduce expenses, get it as tight as possible, operating at a realistic level. And I share realistic level because, for example, maybe we can save on payroll here or there because we have multiple assets in the market, meaning we can spread some costs across those assets. Well, the future buyer may be just buying this one asset. So they're going to have to factor in maybe, say, slightly higher payroll, or they're not going to be able to share a maintenance supervisor across multiple properties. So we need to be aware of that so that we don't have any surprises when offers start rolling in and like, wait, why is the offer lower? Well, because their payroll is more expensive, right? So we have to be thinking about all that stuff. So this is where basically 6 to 12 months out from when we're anticipating a potential exit, we start talking to brokers. We get what's called a broker opinion of value. And using their market expertise, they'll come back to us and say, look, in today's market, this is our per door cost we think we can get you. The buyer pool is strong. We think now is a great time to sell. But perhaps they come back and say, hey, look, NOI is great, cap rates are strong, but we're seeing some challenges in the marketplace raising capital. So you might have fewer investors or fewer operators looking to buy today. So their recommendation might be to wait 6 to 12 months, right? And so leveraging their intelligence and our own market experience to make that decision on that appropriate time and understanding who are we selling to once again? Is this a value add buyer? Is this more of a core plus buyer that just wants an existing asset that's running well? They're not really looking for 12 or 20% returns or cash on cash of 10 or 12%. That 6 to 8% is attractive to them, right? So the best time to exit is when your NOI is fully stabilized. Your net operating income is stabilized. Your CapEx program is largely finished. Once again, the strategy and the capital might be there to continue to renovate units, but all the exterior improvements have been done, the amenities have been refreshed, units have been renovated, and we've proven out our thesis. Of course, we need to time it when buyer demand is deep and pricing exceeds our hold value, right? So, in other words, it's more advantageous to sell today than to continue to hold that property. So, some watch outs, right? So, when you get these loans, we typically get loans from Fannie Mae and Freddie Mac. And these, you can get a 3 year, 5 year, 6, 7 year, 10 year. We're typically doing 5 year. And so if you exit early, there are things like prepayment penalties or defeasance, right? So we have to factor that in. It's interesting. We were actually looking at a deal that somebody brought to us where they were proposing we co-invest. Now, we don't really do that, but we're all about building relationships and nothing ventured, nothing gained. So we're looking. And what we found is they had not even underwritten that prepayment penalty into their underwriting. And in some cases, that could be 1% of the loan value, right? So that would be a very significant hit to the bottom line when you exit that deal. So making sure you're factoring in whatever those potential prepayment penalties or defeasance is to sell and get out of that mortgage early. Obviously, looking at things like tax impact, what's happening in the marketplace. Is this the right time to sell from a tax exposure component? And are we selling into the right kind of market? So that is Faris Capital Partners' ultimate strategy. We want to exit these deals at the right time. We do 5 year holds with an optional 2 year extension. So if the market's not right at 5 years, we can extend for 2 more. But we also like to start thinking about it in year 3 because ultimately our goal is to get our business plan done quickly in the first 2 years, optimize that NOI and the operations, and then start looking for that exit with the goal of getting our investors' money back to them as quickly as possible, but most importantly, while maximizing their returns, right? So all these things are factored in. Now, that said, we also have to say, well, what if something's going on in the marketplace where, hey, NOI is great, cash flow is coming in, the deal's still operating well, but due to broader global economic realities, it's just not a great time to sell. So there could be an opportunity to refinance, right? So we go to some lenders, we look at some debt options, and there's an opportunity to refinance, take some cash off the table, get that cash back to our investors, continue to hold the property and cash flow it until the right time to exit. So this is best when debt markets are friendly, right? So, interest rates are lower. The debt service coverage ratio on our property. So, in other words, the ratio of what is our mortgage compared to our income, right? If it's strong, and if there's still some upside that remains, where even after the refi, we can perhaps continue with some additional value add unit renovations. And bottom line is we're doing this because a sale would leave some money on the table, right? So we always look at that. What does the refinance option look like? Now, the challenge there is nobody can predict what the interest rates will be in 2, 3, 5 years. I mean, you can't even predict what they're going to be tomorrow. Treasuries are always moving up and down. And so you got to be really cautious making that your plan. The reality of, and this is just coming from my view, I'm not an economist, but the environment we've had in the United States of 2 and 3% interest rates, I don't foresee that ever coming back in the foreseeable future, unless there's some sort of global calamity in the economy. It's great we have low interest rates, but the economy's in major trouble, right? So I think we're going to see interest rates stay roughly where they are today, fluctuate 1% or 2. And the reality I think that's super important to keep in context is that the mortgage rates that we're seeing today, whether in residential real estate or on these types of deals, is actually about average of where they've been over 30 years. It just feels like they're high because we've come off of this extended 10-year period where rates were absurdly low. So the refinance option is there. It's something we look at. It's just part of our conservative underwriting approach and making sure we have multiple exit options and scenarios available to us. Now, third, is a recapitalization with a potential partner buyout. So, in other words, a partial exit. So, that's where you potentially bring in some new equity. You could take out some of the original capital and get some money back to your investors. This is sort of best when the asset is performing and maybe perhaps some of our investors and we like the ideal of a longer term hold. So we've looked at some deals recently where by year 5 we're hitting like 9 and 10%, cash flow. And so that could be a scenario where we get with our investors, we talk through this strategy and we say, hey, are you interested in staying in this deal and just enjoying that large cash flow? And maybe we hold the deal for 10 or 15 years, right? And look for that exit in the future. So that's another option. But the obvious watch out there is, new fees, right? We got to go out and raise more capital. The capital raising environment perhaps is different, and so we have to create some new splits and waterfall structures. And there's alignment across all of our asset share classes, I should say. So that's a strategy I don't really ever see happening. In other words, if we found a deal that like that, where we felt that 10-year, 15-year hold made sense, we would probably just structure the deal in that way out of the gate, knowing we could always exit sooner if something changed, right? But we've looked at some deals where it's like, this maybe is a 10-year hold. Let's think about it. But the deals always fell apart for reasons outside of that. It was just maybe we didn't like the vintage or we toured the rent comps and realized it wasn't the right asset for us. So you may see a deal like that from us in the future, but right now we're still focused on those 5-year holds with a quick exit. Now, the fourth one I mentioned is, the opportunity to 1031 exchange. So for our Canadian listeners, a 1031 exchange is the ability where you can actually sell an asset, an investment property, and transfer the equity that you received into a like kind investment. And so that is available to US investors, but not Canadian investors. So it's not something we factor into our potential exit strategies. It's just not something we're looking at because so many of our investors would not receive any benefit from that. And we're all about making sure we're going full out for our investors and providing the investing experience in the world. So our decision framework, we run it through all these gates, right? So the value versus hold math. What is today's cap rate on stabilized NOI versus our yield on cost and forward-looking NOI? We look at the debt clock. How much longer do we have on this loan? Is our DSCR strong? All of those factors. Obviously, things like market liquidity, getting those brokers' opinions of values, like analyzing the depth of the buyer market. Now, we rely on brokers for some of that, but every day we're reading, all the news that's coming out. So, our sales increasing, right? Signaling more buyers are in the marketplace. Are we seeing bid ask spreads compress? So, in other words, what is the property listed for and what's it actually selling for, right? And so we start seeing compression there. If we see cap rate compression, those are also signals that the buyer depth is there, right? And then obviously just that capital availability. There might be buyers out there interested in buying, but if they can't raise the capital to close the deal, it's interesting right now in the United States, many US investors are sitting on the sidelines because they're looking for some signals that were at the bottom. Now, Mark and I recently just did an episode, and I think the signs are clear. We are at the bottom and we're actually on the upswing. So now is one of the best times to invest in multifamily real estate, in our opinion. You can go back and look at that episode where we covered some of those topics in greater depth, I should say, and learn from why we think it's the best time. But bottom line is cap rates are compressing, values are slightly increasing, and the buyer depth is increasing. So the signals are there, right? So then we look at what is our limited partner outcome? After fees, debt, and taxes, does the exit beat the hold IRR and equity multiple, right? So if now's the time we can exit and hit that IRR and that average annual return our investors are looking for, we're going to strike while the iron's hot. And then obviously just assessing risk, right? Like what's happening in the insurance markets? What's happening with tax trajectory? What's the supply pipeline look, right? It's that idea we don't want to be one of 1,000 deals trading at any given time. So timing it right where there's limited inventory being sold, but the buyer depth is there. So there's no perfect time to exit, but it's all about trying to find the most optimal time to exit. So how do we prep for an exit, right? So we start looking at our financials. We're studying those on quite literally a weekly basis. We have weekly asset management meetings. We're looking at what's happening in every level of every property, right? So are we done with our CapEx program? Is our NOI stabilizing and continuing to grow? We've appealed our taxes and gotten them lowered. Everything's looking tight. Everything's looking right. Time to go. Then we start looking at opportunities to tighten up any contracts we have, reduce any expenses, say, for example, on our landscaping, and just really run a tight process. And then as we get into sort of like now we're thinking about listing this property, we're getting photography done, we're scheduling in tours, we're educating, the buyers about our deal. We're putting together a great pitch deck with our broker. And in terms of our property level, we're keeping concessions low and collections tight, right? So just making sure we're operating at optimal levels. And then when it's time to execute, we communicate clearly with our residents and staff to maintain performance through closing. And that is when we start the exit process. So, the reality is that how do we maximize price? As we get towards an exit, we don't want to take on like big, massive projects, right? We want to look for the small levers that have a big impact. So minimal effort, high output, right? So, finishing the story, making sure everything is tight with our CapEx program, signage is good, the property is clean and clear of trash and debris. We scrub expenses, we rebid some contracts where possible. We get the payroll right size, and we make sure our utilities are normalized so trailing costs look durable. We're always looking to add other income throughout the ownership, but if there's ways that we can tighten that up further, so things like maybe some reserve parking, storage units on site, pet fees such as move-in and cleaning fees, RUBS, which is ratio utility billing services. So making sure we're maximizing that per what's allowed in that particular municipality. And we're just documenting and making sure everything is consistent in that 90-day leading up to that exit. We also want to make sure our reputation looks strong on Google. We always aim for at least a 4.4 or higher star average. Buyers are checking that just the same as a resident is. And we make sure our make ready is tight. We're turning units in 10 days or less. So eliminating any mystery about down units before tours. In other words, we've toured properties before where we walk into a unit that just was exited, the resident just left, and it's a total pigsty. And I'm sitting here thinking, geez, we're going to have to come in here and clean this up. And no different from a buyer buying a residential property or a resident picking an apartment building, buyers are responding to the aesthetics and they're responding to the quality of the tour and the quality of the asset. So the tighter our operations, the cleaner the property, the more excited they're going to be about buying that particular property from us. So, bottom line is you just have to have a multiple exit scenarios outlined. You have to have a clear plan, you know, control the risk where you can. So make sure you use fixed rate debt, or if you're using floating rate debt, it's capped. So you don't run into a situation where your interest rate skyrockets, thereby driving down the value of the building. Keeping strong reserves in place, that 6 months principal and interest plus that 10% capex contingency, and then making sure we have multiple plans if new information arises and it might not be the best time for an exit. Hence, as I mentioned before, that refi scenario. Now, in terms of like communication, we're big on that. We guarantee monthly communication and updates on all of our investors to, guaranteed on the 30th of each month. But, if we're thinking about an exit about 6 months out, we're going to start communicating with our investors that here's what we're thinking, here's what we're working towards. 3 months out, once we know what the plan is really starting to shape up like, we're confirming the path with rationale and projected ranges of where we think we might end up. And then at execution, it's all about just keeping everybody informed on timelines, key dates, and what to expect at close, your funds flow, tax documents, any next steps, and then post close, that final accounting. And, for us internally, obviously what we do is an after action review. What could have done better, and what things do we need to think about so we do an even better job for our investors. So all that to say, you have to have multiple exit strategies. You have to be clear on who your potential buyer might be. Otherwise, you might turn a great deal into a mediocre deal without having that forethought baked into your business plan. Now, if you've enjoyed this content, you'd like to learn more about what we're up to here at Faris Capital Partners, go to fulloutinvesting.com. We have a great video that walks you through our entire process from soup to nuts, from finding the deal to exiting. There's also a sample deal deck so you can get a sense of the types of deals we're targeting. And there's an opportunity for you to book in a call. If you'd like to be added to our investor list where you get updates on our deals, book in that call so we can talk with you and make sure it's the right fit for you and for us. Thanks so much for listening. If you enjoyed this show, please subscribe and like and share with other high net worth investors that you think could benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you. Keep dreaming and investing big.